Hello traders, Gary Wagner here just after 12 noon in Honolulu, 6 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is June the 5th, 2020, and this is the daily report for gold and silver, our weekend review, and what a week we have seen with two major reports really resulting in major drawdowns in gold, silver, platinum, and palladium. Gold really got hit hard, lost about $60 on the week. In terms of where it's going to go next week is going to be the primary focus when we look at our technical studies, but first to the price board. It was like the 1-2 punch for gold, starting on Wednesday with ADP's jobs report, and then today the U.S. Labor Department's jobs report, both coming in well under expectation and forecast. That sent U.S. equities flying, and it had a dramatic and strong downside pressure on the precious metals. You can see that gold gave up almost $40 today, $38.80, a decline of 2.25 at 1688.60. When we look at spot, that was down about $31 today, and that's at 1681.60. Platinum also gave up a good 3.5%, 834.50. Palladium seems to buck the trend on up days and down days. That was up $43 at 1966. And lastly, silver gave up about 50 cents, back under 18 at 1757. And for the first time in 8 consecutive trading days, we saw the dollar actually move higher. Let's take a look at our technical studies. We have been flat with no active trades, but we'll speak about different levels that we can look at and what we can expect over the next 2 months. Traders, the truth of the matter is the combination between the ADP jobs report and the Labor Department's report today was a dramatic sell-off in gold throughout the week. In fact, when we look at a weekly chart, we can see that we lost about $60 in terms of pure value. Currently, per ounce of gold on the futures exchange is going for $1,688, roughly in that area. The key, though, what's most important on a technical basis is a couple of things. First of all, we have this lower level support line. We've really picked the two lowest lows that came in to create it. The first one was this low that came in at the beginning of April, and then this low that came in recently at the end of May. When we do that, there's absolutely no doubt we have a clear and decisive break below that on a closing basis. If we get follow through or continuation of selling pressure next week, where could we see gold go to? Well, the first thing I'm going to look at is a fib retracement. It is of the entire trading range from the middle of March up until the highs of April, and we look at the 38.2% Fibonacci retracement level, comes in at 1660. So that would be the first level if we get a continuation of the market dropping that I would look to see some kind of support come in. However, if it is steeper than that, we could see 1647. That's based upon a series of tops. It's not a fib level, but the 50% retracement comes in at 1620. Now, if we saw the conclusion of the sell-off this week and we're going to see higher prices next week, which I do believe has a low probability, but nonetheless, if that occurrence does unfold, the levels that we would look at in terms of upper level resistance are 1741 and 1763. Those are based upon recent tops in the market, and then of course 1788. We are looking at a 480-minute candlestick chart of gold futures, a continuous contract. The reason that I like this time sequence is that basically we're looking at 4 bars per day. Now, based on what we have seen, we can certainly say that gold has sold off and sold off hard this week. The top came in at approximately 1760. As the market broke down, you can see that we've got a fib retracement. We landed directly on the 50% retracement. Now, that is not a fib number per se. However, it is used quite frequently by market technicians because we've seen it have some weight. And here's what I'm talking about. Take a look at these certain areas at how the market traded when it hit this particular price point. We have multiple occasions where the market traded down to this level and then popped back up. And we see that on a number of occasions. Right here, we get that V. Right here, again, this is a shorter move, but nonetheless, finds support, comes up, finds support, comes up. And then when we look at the tops of the markets, and that's what's important right now, we really do have a flat top. In other words, we have 1760. Of course, we have 1788, and we know that's going to stand alone. And the other one that's going to stand alone is this one right here at 1775, because there's only two occurrences. So we know that we're trading in a sideways market. We know that the market has been under pressure. We have seen on a number of occasions through the last couple of months that every time it hit this particular price point, meaning at approximately 1680, we have seen the market trade back up and then find resistance somewhere around 1760 to 1775. So in terms of what we're going to look for next week, we'll probably see a rebound. And if we do see a rebound, realize that we don't have any indication right now that we have changed the basic outlook from that of a sideways trading consolidating market to a trending market. However, we are now at the bottom of the range, and if we want to catch the move from, say, 1680 to 1760, that's still an $80 move. But we have to be cognizant of the fact that we're not getting these true trends right now, and we might even see selling pressure next week. This has been Gary Wagner, wishing you, as always, good trading. We will go into the week flat with no active trades, and we'll talk to you on Monday for the next daily update and review. Bye-bye.